S&P futures are absolutely bleeding out right now, down 1.5% to roughly 74.29.
Yeah, and the Nasdaq is taking an even bigger hit.
Exactly. We are looking at a pre-market drop of 2.6% on the Nasdaq futures, shedding down to 30,263. Dow futures are off 0.7%. I mean, the bell hasn't even rung yet on this Tuesday, June 23rd, and the overnight session is just a sea of red.
It is a massive global tech capitulation. I mean, there's no other way to frame it. The implied open is incredibly ugly.
Right. It's like, imagine you're at the most high-energy, totally chaotic party of the decade. Let's call it the AI boom.
Yeah.
Everyone is making money, the music is loud, and then bam, someone just flicks on the fluorescent lights, kills the music, and hands you a massive tab. That is the exact vibe we are seeing in the pre-market volume today.
It really is. The lights are on, and investors are getting a huge reality check.
So our mission for this deep dive is to parse through all the overnight catalysts and figure out, is this a gap and go scenario where we just keep selling off, or is there a floor? Because you have to look at the macro plumbing first.
Always start with the macro.
Right. And there was this huge headline overnight about a newly negotiated U.S.-Iran peace roadmap. Now, normally you'd think easing Middle East tensions means lower crude oil prices, which is usually a massive tailwind for equities.
Right, a tax cut for the consumer, basically.
Exactly. But
Right.
the tape didn't bounce at all.
Well, because that relief rally was capped almost immediately.
Right, by the warning out of Washington.
Yeah, President Trump issued a very stark warning to Tehran regarding nuclear compliance right after the roadmap dropped. And look, we aren't here to take a political stance on that strategy, but strictly from a market mechanics perspective, what does the market hate more than anything?
Uncertainty.
Exactly. It hates uncertainty. So that warning instantly injected all that geopolitical fragility right back into the system. It totally neutralized the crude oil relief.
Okay, so the geopolitical pressure valve is stuck, but I'm looking at our data, and the real invisible killer today isn't overseas. It's right here. It's the Hawkish Federal Reserve under Kevin Warsh.
Yeah, the tone shift is violent. What's fascinating here is how the market is finally waking up to the reality of the June Fed meeting. I mean, for months, retail traders have been holding out for a dovish pivot.
Begging for rate cuts, really.
Right, begging for cuts. And then we get the dot plot. 9 out of 19 policymakers are projecting a rate hike in 2026.
A hike, not a pause, a literal hike.
A hike, with an 85% chance of it happening by year-end, maybe even the September print. And that is giving us a brutal double-fisted macro headwind today.
Oh, you're talking about the yield and the dollar.
Precisely.
Yeah.
The U.S. 10-year Treasury yield just recaptured 4.51%.
Wow.
And the U.S. dollar index, the DXY, hit a 13-month high near 101.18.
Okay, we have to break down why those two specific numbers are absolute kryptonite for tech stocks right now. Because an active trader sees a 4.51% yield and immediately knows the growth multiples are getting crushed.
Right, because of multiple compression. It's just math. These hyper-growth AI companies are valued on cash flows that are supposed to happen 5 or 10 years from now.
And when you discount those future cash flows back to today using a higher interest rate, the present value just shrinks.
It evaporates. And then you add the strong dollar on top of it. A GXY at 101.18 means that for any multinational tech firm, their software just got way more expensive overseas.
Yeah, they get penalized on the currency conversion when they bring those earnings back home. So it's a massive squeeze on current revenue and future valuation.
Exactly. So what happens when the entire AI sector requires hundreds of billions of dollars in borrowed cash to build out data centers?
The cost of capital explodes and the foundation cracks. Which brings us to the Asian chip shock from the overnight session.
Oh, this was wild.
It was. South Korea's KOSPI plunged 10%.
10%.
10%, and it triggered a market-wide circuit breaker. And the pain was heavily concentrated in the AI titans. Samsung and SK Hynix cratered over 12%.
Yeah.
Because there's a report that SK Hynix might slow down its AI memory chip expansion.
Which is the canary in the coal mine. If the company making the physical shovels for the AI gold rush is halting production, that means they see demand drying up.
Right.
And that Asian contagion is absolutely spilling into U.S. mega caps today. Look at Alphabet. GOGL slid 5% yesterday.
And that wasn't just macro.
No, not at all. They had some major AI leadership departures. The street is giving all these hyperscalers, Amazon, Microsoft, Alphabet, a massive AI Capex reality check.
Capex being capital expenditures.
Right. They are spending billions, but where is the enterprise software revenue to justify it?
It's like building a $10 billion data center on a variable rate credit card right as the Fed hikes rates. Everyone's suddenly wondering if anyone is actually going to rent the servers.
Yeah. And if we connect this to the bigger picture, this is a structural liquidity trap.
Okay, unpack the trap part for the traders listening. Why can't momentum buyers just hold their bags and wait it out?
Margin calls. Late-stage momentum buyers chased the recent highs using leverage. They borrowed cash from their brokers. When the tape drops this hard, brokers demand more cash. If you don't have it, they automatically liquidate your positions.
Which creates forced selling.
Forced selling, which drives the price down more, triggering more margin calls. It's a vicious cycle.
Which is the perfect segue to the most heavily watched ticker on the board right now, the SpaceX stress test.
SPCX. This is the ultimate case study for today's market.
It really is. So SpaceX is down 16.4% to $154.60 on Monday. This is their third down day in a row.
Right.
And just for context, they IPO'd at $135 back on June 12th. They ripped up near $190. But now they've filed for their first ever public bond sale, and the street is just hammering them for it.
Well, yeah, because they are trying to raise capital in a 4.51% yield environment.
Right.
Think about it. Why would a bond investor lend money to a volatile space exploration company unless the yield on that debt is significantly higher than the 4.5% they can get risk-free from the government?
They demand a massive premium, like what, 7, 8%?
Exactly, maybe higher. And those debt servicing costs will completely eat into SpaceX's operating margins. It raises serious red flags about their long-term runway. Funding Mars missions is not cheap when money actually costs something.
So let's look at the actual levels for SpaceX today. Where is the line in the sand?
Okay, so the bull case. Buyers absolutely must reclaim the day one close of $160.95 to stop the bleeding. If they catch a bid there, they might stabilize.
And the bear case, if they gap down.
The trapdoor is $150 flat. That was the day one opening price. If it breaks below 150 on a heavy pre-market volume, it's a gap-and-go scenario straight down to test that original $135 IPO price.
Brutal. So with growth tech getting decimated, we are seeing a violent rotation into safety. Defensives are catching huge bids this morning.
The ultimate shock absorbers.
Yeah. Clorox, ticker CLX, is up 4.76% pre-market. Hershey, HSY, is up 3.49%.
It's all about inelasticity.
Right, because people still buy bleach and chocolate even if the AI bubble bursts.
Exactly. High dividends, predictable cash flows. In a 4.5% rate environment, that predictability is gold.
But let's look at some of the top gappers that have nothing to do with AI or the macro environment, because there are some individual corporate implosions happening this morning.
Oh, Primoris Services, PRIM.
Yes. Down an unbelievable 33.55% to $71.99.
It's just a total execution crisis.
Completely. They slashed their fiscal 2026 net income guidance from a range of $223 to $234 million, all the way down to $71 to $101 million.
That is a massive miss.
Over half their projected income wiped out because of renewables cost overruns, and their COO, Jeremy Kinch, resigned immediately.
Yeah, and KeyBank downgraded them. Look, in a tight market, institutional money has zero patience for management blunders. A guidance cut like that, plus a C-suite exit. It's toxic.
So what are the levels for PRIM? Because at $71.99, it looks like a falling knife.
It is a falling knife. If that $71.99 floor breaks off the open, it's an absolute free fall. Buyers would theoretically need to defend the $100 psychological level just to attempt a relief rally back up to their Q2 share repurchase average of $111.29.
But getting back to 100 from 71 feels like a massive stretch today.
It's a pipe dream today.
Okay, let's look at Carnival Corp, ticker CCL. It's earnings day. The print shows an expected EPS of 34 cents on $6.69 billion in revenue. Now, Carnival has 85% of their fiscal 2026 booked at historic pricing.
Right.
But they have this massive overhang with high global fuel costs.
Which is a classic margin sustainability problem. You can have every cabin booked for the next 2 years, but if commodity inflation doubles the cost of the fuel to run the ships, your bottom line is gone.
So how is the options market pricing this?
The options chain is pricing in a 5% move on the earnings print. The bull target is pushing past the $32 resistance level, maybe heading towards Stifel's $36 target.
And on the downside?
Bear target is a break below $30.15 to go test the double bottom support down at $28.
Okay, we need to zoom out and give our listeners the broad market index battlegrounds for the day. Give me the lines in the sand for the S&P and the Nasdaq.
For the S&P 500, bulls must reclaim yesterday's close of 7,484. If they can't, and we break below 7,375, the trapdoor's open.
And the Nasdaq 100.
Needs to climb back above 30,571 to prove this isn't just a fake-out short-covering bounce. If buyers don't defend 29,355, the daily uptrend is structurally broken.
So we have the macro, the tech crash, the defensive rotation, the levels. But how is the retail trader handling this pre-market action?
According to all institutional flows, they are walking straight into a trap.
The classic retail pain trade.
Yes, they are aggressively buying this AI dip, assuming we get a soft landing and the Fed magically cuts rates. But they are totally blind to the institutional reality. There are three elements to this pain trade.
Break them down for us.
First is the collapse of the equity risk premium, or ERP. With a 10-year yield at 4.51%, the premium you get for taking on massive stock market risk versus just holding safe government debt is basically zero.
Right. Why risk everything catching a falling tech knife when you can get 4.5% guaranteed?
Exactly. Second is the duration trap. Retail is holding long-duration growth tech. If yields stay higher for longer, as the Fed indicated, those multiples stay compressed.
They get crushed. Okay, what's the third element? Because this is the one that really stood out in the research.
The broken diversification hedge. Right now, the stock-bond correlation is positive 0.25.
Wait. Normally, if equities sell off, bonds rally, right? That's the entire premise of the 60/40 portfolio.
That is the textbook theory. But this raises an important question for active managers. What happens when the textbook stops working? A positive correlation means stocks and bonds are dropping together.
Wow.
If tech keeps crashing today, your bonds aren't going to save you. They will fall right alongside your stocks. The risk-free rate is driving the entire bus. And the old rules of diversification are totally broken right now.
So the traditional safety nets are just full of holes. So to wrap this up, we are looking at a brutal collision today. A hawkish Fed, a 4.5% yield environment, and an AI Capex reality check that is dragging down the tape globally.
And it is forcing a massive rotation out of momentum and into defensives.
Absolutely. So as you trade the open today, keep your eyes glued to those levels. Watch if the S&P can reclaim 74.84, see if the Nasdaq can push back above 30,571, and definitely watch SpaceX around that $150 psychological floor.
Watch the volume on that open.
For sure. But I want to leave you with one final thought to mull over today. If the classic 60/40 portfolio is fundamentally broken because stocks and bonds are dropping together and holding cash just guarantees you lose to inflation, what does the true safe haven actually look like in this market? Where is the smart money going to hide when the traditional lifeboats are sinking?
That is the trillion-dollar question for this cycle.
It really is. Keep your heads on a swivel out there today, manage your risk tightly, and whatever you do, respect the tape. We'll catch you on the next deep dive.